Hey students, in this video we're going to be talking about taxation and government spending with chapter 14 starting with lesson 1. Taxes can have a far-reaching effect on the economy. As you all know, businesses do not absorb costs, they pass it on to the consumer. Anytime a tax is implemented on a good or service, it will have a negative effect. Because when taxes go up, when prices go up, consumers have the propensity to buy less. Since consumers spend less, businesses make less money. When businesses make less money, they have to cut costs. And the biggest cost-cutting measure businesses can make is laying people off. This does not always happen, but if a tax is large enough, it can have this effect. Sometimes it's intentional. Some taxes are implemented to curb the consumption of certain products. Prime examples are tobacco and alcohol. Here in the great state of Texas, there is sin taxes or excise taxes that fund parts of the education budget. It is no secret that the long-term consumption of alcohol and tobacco have negative effects on health. Since the outright ban of these products will not work, example is prohibition, taxation is the route that government takes. Now we would take a look at the characteristics and types of taxes that the government uses to gather revenue. There are 3 characteristics of taxes: equity, simplicity, and efficiency. Now, some taxes may not have 1, 2, or all of these characteristics. Equity is the fairness of a tax. The immediate question that comes with equity is, what is considered fair? This is a matter of political and economic opinion. Some people believe that the more one earns, the more that they should pay in taxes. And then there are some that believe that each person should be taxed the same. Simplicity means that the taxpayer and the collector can understand the tax imposed. Now, some taxes are very simple, such as sales tax. Here in Texas, the sales tax is 8.25%, which means that it is very easy for anyone to calculate it. On the other hand, the federal income tax is far from simple. It is often extremely tiresome to pay. Last is efficiency, meaning that the tax should be easy to administer and actually generates revenue. Now with computers, it has become much easier to administer taxes and pay taxes, but there are still some difficulties with the amount of jargon and lack of definitions of deductions, costs, etc. With taxes, there are 2 principles of taxation. The 2 principles are the benefit principle and the ability to pay principle. The benefit principle states that those who benefit from government goods and services should pay in proportion to the amount of benefits they receive. This means that if the government provides something, those who benefit most from it should pay more. A good example is gasoline. In the price of gasoline, there is a tax applied to it. The intention of the tax is that those who use roads the most should have to pay for the roads the most via a tax, and that's in gasoline. This means that if you do not purchase gasoline, you're not paying, in part, some of the roads. Hashtag Tesla. The second principle is ability to pay. The principle is the belief that people should be taxed according to their ability to pay. This principle is built into the individual income tax. That the more one earns, the more that they pay, because it is believed that they do not suffer the tax as much as someone who does not earn as much. In the United States, there are 3 different types of taxes: proportional, progressive, and regressive taxes. A proportional tax imposes the same percentage rate of taxation on everyone, regardless of income. That means that if you earn more or earn less money, the percentage of that tax does not change. Medicare is a good example of this. The percentage tax of Medicare does not change based on your income. A progressive tax, on the other hand, does change based on your income. A progressive tax is where the percentage of income paid increases as your level of income increases and decreases as your level of income decreases. And finally, we have regressive taxes. A regressive tax is where the effects of taxes go up as your income goes down, or taxes where it is enforced more on lower income earners. Now, regressive taxes are not intentional this way in their nature. Instead, this is found through mathematics. Essentially, the idea of regressive taxes are that although the tax is the same for everyone, 5% for low-income earners hurts them more than, let's say, 5% on those who earn more. That is the idea of regressive taxes. We'll talk more about that the next time that we're together. But until then, please make sure that you guys are reading your book, wash your hands, do not touch your face, and stay indoors.